Hi, this is Tron Welch with Welch Financial Planning, and thank you very much for joining us for the second quarter economic update 2024. For those of you that don't want to spend 10 minutes on this call, real quick, inflation will probably be sticky and may decline in 2025. Interest rates will probably decline towards the back end of 2024, but nothing really spectacular, and very, very low, nearly impossible for having a recession in 2024. So let's go through some of the background on why I come up with these conclusions and supporting evidence that I have for you today. Starting with the economic growth and composition of the GDP. So this is a slide that I show over and over again because I think it's really important and really powerful. This goes back to 2001. And the point that I want to make here is that we've had a couple really economic upheavals, obviously in 2008 with the housing market and then COVID in 2020, but we remain on a 2% growth rate during that time period. And so I'm here to make the argument that all the gyrations that the government makes between increasing taxes, decreasing taxes, increasing Fed rate, lowering Fed rate, printing money, destroying money, none of that really is math. It all comes down to we're on a 2% growth trend, and that's where we're going to stay. So moving on next, let's look at inflation over a 30-year period. We can see a pretty nice decline from 1996 to 2020, and then spiking back up to 2022, and then just kind of bouncing around to that 4% rate over the last couple of years. So looking at it a little bit more focused in on just the last couple of years, this is the monthly 12-month, and you can kind of see where it really has settled into just below 4%. I would argue that this is where we're going to be. The Federal Reserve has come out and stated a goal of a 2% inflation. I'm not really sure that they're going to achieve that. They've kind of used all the quivers that they have, and if they haven't achieved 2% by now, I don't think they will. So I think they would have been better served by stating a 3% inflation, which was when I took Economics 201 in 1988. The Federal Reserve goal was 3%, and why they moved it to 2 is beyond me, but it'll be hard to achieve that. So from here, let's look at a little bit of what's contributing to the inflation. And what I really like about this slide is that it shows that different sectors or different portions of the economy are taking turns driving inflation. And if you kind of start back at May of 2022, you can see energy represented in green being really the big driver of inflation, taking up about a third of the inflation was close to energy. But now when we slide off to January of 2023, as energy costs came down, it's actually deflationary, and you can see the below zero starting in January 23 till basically today. But then the thing that's kind of catching people now is the auto insurance and home insurance, and we're seeing rate increases of 20% as renewals come around. And I'm not sure that I certainly understand the home insurance between the wildfires and hail and all the natural disasters. I mean, I'm not sure how many homes got wiped out in the tornadoes over the last 48 hours, but certainly a significant number of them that home insurance will continue to rise. I would think auto insurance would come down with all the safety features that we have in cars, but apparently repairing them is outpacing the cost of the benefit of the safety features. So anyways, that's where we are now. Basically, shelter is the largest component of that, although it is declining a little bit, but rents and obviously mortgages are moving quite a bit. One of the big drivers of inflation is M2, and you can think of M2 as the money supply. And that is kind of what's readily available in short-term CDs and money markets and checking accounts and saving account. And you can see, really in January 2020, it just skyrockets as the federal government is spending money trying to get us out of COVID. And then at January 2022, it's kind of moved sideways, declined a little bit. But there's just so much, and remember, we're talking about trillions of dollars here. So we're talking about $21 trillion basically in checking accounts and accessible, that it's really hard to maintain strong discipline of purchasing when that much cash is floating around, and that's really what's driving the inflation, is the access to M2. So a little bit more analysis on M2s. You can kind of see in the demand deposits, and this is in trillions again. So in December of 2019, there's 1.6 trillion in demand deposits, and February 24, most recently is 4.9. So basically we can write checks of $5 trillion at our fingertips to buy for cars and vacations and property and casualty insurance and all that. So it's just hard to be a disciplined purchaser at this time when cash is slushing around. So inflation being present should be no surprise to anybody. And one of this is the loans and leases and bank credit, all commercial banks. And I thought this was kind of interesting. You can kind of see, a little bit post-pandemic really declining, spiking up, kind of coming out of COVID, if you will, in January 2022 to where kind of hitting, a little bit more mellow slope January 2023. And it's just kind of slightly moving upwards. And I think what we're basically saying is that most businesses are able to fund their growth and expansion, not through lending, but through cash. And there is just so much money floating around that people aren't relying on banks as they once did to grow their business. So here's the Fed funds and interest rates. I do like this slide, just looking at 2021 towards the right side. I mean, it's just an absolute wall straight up of increasing rates from basically 0 to 5.25% in a very short order of time. And now we're kind of plateauing, and it's going to be sticky for a little bit. The market believes that we will have one cut in rates in 2024 and possibly a second on that, and then a couple then in 2025. So this is significantly stickier than what we thought it would be. And if you go back to the economic update that I did maybe a year and a half ago, you're going to see basically the same chart, except for that interest rates would drop faster and sooner than what has actually happened. So some of the inflationary piece is we're going back to labor demand, and I've made some statements in the past which I have proved true, and I think we're still kind of there. So on the left hand side here, we see the JOLTS, which is the number of job openings. And basically a couple of years ago, when we were worried about recession, I just didn't really believe that was going to occur, and then it would be really difficult for a recession to take place when there were so many, when there was 12 million open jobs. I just could not wrap my head around that we were 90 days away from a recession with 12 million open jobs. Now, that number has dropped significantly. January 2024, now there's only 8.8 million open jobs, so a real steep decline. But before I think we start sniffing and saying the word recession, we would need the JOLTS probably to be at the 4 million number. So I'm not exactly sure how a recession would possibly occur with this many job openings. One chart that kind of supports this is the number of unemployed people per job opening. And, we're just at historical lows. I mean, there's basically, for every unemployed person, there's a job available. And so, the reason that unemployment is under 4 and not really going lower is that you have to find the right person for the right job, and we just kind of probably have a little bit of skill set mismatch as people kind of try and move from maybe their current job to a better job, or maybe from a non-job to a job that they really want and they'll accept. The unemployment is not moving anytime soon. So let's go back a little bit to the interest rates, and to me, I just find this fascinating. Where when the 30-year fixed was sitting at 2.75, which was really in recent memory, lending or borrowing $500,000, your monthly payment was just over $2,000. Now taking our current rates of 7.8%, that same $500,000 loan, that payment is $3,600. That is a 77% increase in monthly payment. So obviously people can't afford that, so housing prices must be declining, but when we look at the next chart, it's not. And this is the Case-Shiller National Home Price Index. And you can see 2020 housing prices really increased. Rates were dropped, quite a bit lower there. But then even with the rates over doubling, again, driving that payment up 77%, you're not seeing much of a reduction in real estate pricing. It is still high and certainly not dropping. And I don't feel like it is anytime soon. People are showing up with cash, or they're okay handling the new payment. But either way, housing prices are not declining, which you would think, in an academic sense, that would occur when you double the interest rates of a 30-year mortgage. But that has not happened. So kind of in summary of where I'm getting to is the moving of interest rates may, in an academic sense and in a historical sense, been a big driver that you could help control the economy with increasing or decreasing interest rates. And I believe that there's significant evidence of that not being true in today's environment. Somewhere between the concentration of wealth, the excess and unprecedented amount of cash floating around, that interest rates are just not as an important driver of the economy as it once was. And so we've shown up to try and slow down the economy using interest rates as a tool and a leverage that just isn't working, and it's not really impacting things. And so that's why I don't believe that the Fed ever will be able to control much of inflation by using interest rates with this much cash laying around. So with that kind of brings us back, to the three, big ideas that I wanted to bring up for today. And that was inflation's going to be here for a little bit. We're going to see a slight decrease in interest rates towards the end of the year, but I don't think it matters. I don't think your buying habits are really being influenced by inflation. There's no evidence that you're slowing down on your shopping and your spending, even though inflation is increasing, but more importantly, interest rates are increasing. And the probability of a recession in 2024 seems absolutely minimal to zero to me. And so those are the thoughts that are on my mind, the things that I'm keeping an eye on. If you have any questions, feel free to give a call, always available for you. We'll talk to you soon and take care. Bye-bye.